Hello everyone, and welcome back to SparkShift. Today, we're diving into an essential topic in options trading, call options and the covered call strategy. In this video, I'll break down what call options are, how they work, and show you how covered calls can help generate additional income from stocks you already own. Before we get started, please note that I'm not a financial advisor, and everything we discuss today is for educational purposes only. Always do your own research and consult a professional before making any investment decisions. If you enjoy this content and find it helpful, please hit the like button and subscribe to our channel for more practical financial insights and educational guides. Now, let's dive in and learn about these powerful tools together.
All right, so what exactly is a call option? Imagine you're at a carnival and someone sells you a ticket that gives you the right, but not the obligation, to ride the Ferris wheel at a fixed price later in the day, even if the price goes up once everyone finds out it's the only ride. That ticket is like a call option in the world of stocks. A call option is a contract that gives you the right to buy a stock at a certain strike price before a specific date, the expiration date. For this privilege, you pay a fee called the premium. Let's break it down with an example. Say you're convinced that company XYZ, currently trading at $50, is going to soar. You buy a call option with a strike price of $55, expiring in 1 month, and you pay a premium of $2 per share. Now, each option contract typically covers 100 shares, so you shell out $200 total. If, by expiration, the stock jumps to $65, you can exercise your option to buy at $55, then sell immediately at $65, pocketing the difference, minus that $200 premium. Pretty sweet, right? But, and there's always a but, if the stock doesn't hit $55 before the option expires, then your ticket, like that carnival ride ticket after closing time, becomes worthless. You lose the premium, which, hey, might feel like dropping a few bucks into the cotton candy machine and getting nothing but melted sugar in return. Let's say you're super bullish and you own 10,000 shares of company XYZ. Instead of buying the stock outright, you could use call options to control a bigger chunk of it with less money up front. Just imagine, you spend a fraction of what you would if you bought all those shares, and if the stock shoots up, you're laughing all the way to the bank, unless you forget to check the expiration date and miss out, and then you're the one laughing at your own mistake. In summary, a call option lets you bet on a stock rising without having to commit a huge pile of cash. But remember, you're paying for the chance, and if the stock doesn't perform, that premium is gone faster than free pizza at a college dorm party. Now that we know what a call option is, let's talk about a strategy called the covered call. Picture this. You already own a stock, and you decide to sell a call option on it. It's like renting out your fancy car for extra cash while you still enjoy the ride. You're covering the call because you already have the underlying stock. So if the option buyer decides to exercise their right, you're prepared to hand over your shares without scrambling for a replacement. Let's break it down with an example that might make you smile. Suppose you own 100 shares of company ABC, trading at $30 per share. You decide to sell a call option with a strike price of $35 that expires in 1 month. For selling this option, you earn a premium, say $1 per share or $100 total. Now here's the funny part. If the stock price stays below $35, the option expires worthless, and you get to keep your 100 shares plus that extra $100 premium. It's like getting a bonus for being patient. But if the stock price shoots above $35, the option buyer might decide to exercise the option. In that case, you'll have to sell your shares at $35, regardless of how high the market price might be. You still keep the premium, but you cap your potential gains. It's a trade-off. Extra income now for the possibility of missing out on a windfall later. Here's a little joke for you. If you have 10,000 shares of this stock and sell covered calls, you might end up with enough premium income to buy a lifetime supply of pizza. If only the stock never decides to party and shoot past your strike price. Let's also talk about probabilities. Some platforms, like, say, Robinhood, might show you a rough idea of how likely it is that your option will expire worthless, meaning you get to keep the premium without selling your shares. For example, they might tell you that there's a 70% chance that the stock stays below the strike price. Now, if you're in it for the income, you can sit back and let those premiums add up. But remember, if the stock goes above the strike price, well, you may be forced to sell, and you might miss out on some of those potential gains. It's a bit like betting on your favorite sports team. You're hoping for a win, but you have to be ready if they decide to lose spectacularly. A covered call is often considered a more conservative strategy because you're not risking naked options. You already own the stock, so you're in a relatively safer position. It's a strategy best suited for when you think the stock will either stay flat or increase moderately. You earn that extra income from the premium, which can help cushion any minor drops in the stock's price.
Now let's chat about the pros and cons, because every rose has its thorns, and every option strategy comes with a twist.
Benefits of call options. Leverage. You control more shares with less money. It's like getting a VIP pass to the concert without paying full price. Limited downside. When you buy a call, the worst case scenario is losing the premium. It's a bit like buying a movie ticket. You might not enjoy the film, but you only lose the ticket price. Flexibility. Options can be used in various strategies to hedge or speculate. Benefits of covered calls. Extra income. You earn premiums on stocks you already own. Imagine that extra cash as a tip for being smart.
Downside cushion. The premium you earn can help offset minor losses if the stock's price drops. Risk mitigation. Since you already own the stock, you're not exposed to the wild risk of having to buy it at a high price if the option is exercised.
Risks to keep in mind.
Call options. If the stock doesn't rise above the strike price, the option expires worthless, and your premium is lost. It's like betting on your team and having them lose the game. No consolation prize.
Covered calls. Your upside is capped. If the stock skyrockets, you might miss out on huge gains because you're forced to sell at the predetermined strike price. Market volatility. Sudden price swings can turn your well-laid plan into a roller coaster ride, without the fun part. Opportunity cost. In the case of covered calls, selling your shares at the strike price might seem like a loss if the market price could have been much higher. Remember, these strategies require a good understanding of your own financial goals and risk tolerance. It's like cooking a fancy meal. You need the right recipe, ingredients, and timing. Otherwise, you might end up with burnt toast instead of a gourmet dinner. Before you dive headfirst into the exciting world of options trading, don't say I didn't warn you. Here are some practical tips. Educate yourself. Options trading isn't like riding a bike, unless you're a stunt cyclist. Invest time in reading, watching tutorials, and even using paper trading platforms to practice without risking real money. Start small. If you're just starting out, consider using a small portion of your portfolio to test these waters. Think of it as dipping your toes in a pool before diving into the deep end. Use tools. Platforms like Robinhood often provide estimates or probabilities of whether your option will expire in or out of the money. While not perfect, these tools can give you a ballpark idea of your chances of keeping that premium. Diversify. Don't put all your eggs in one basket, especially when it comes to risky option strategies. Regular reviews. Keep a close eye on your investments. Markets change faster than a cat on a hot tin roof, so be ready to adjust your strategy as needed. And remember, I'm not a financial advisor, and nothing in this video should be taken as financial advice. Always do your own research and consult with a professional before making any decisions that affect your finances. To wrap things up, call options and covered calls can be fantastic tools in your financial toolbox if used wisely. A call option gives you the right to buy a stock at a predetermined price, letting you leverage your investment with minimal upfront cost. On the other hand, a covered call allows you to earn extra income from stocks you already own, though at the risk of capping your upside if the stock soars. Think of these strategies like choosing between a roller coaster and a merry-go-round. Both are fun in their own way, but you need to know what you're getting into. If you're using platforms like Robinhood, you might see probabilities that help you gauge your chances, just like reading the odds before betting on a game. Remember, the goal here is education and a few laughs along the way. So, if you're intrigued by these strategies, take some time to learn more, practice on a simulator, and always consult with a financial advisor before making any moves.
Thanks for watching SparkShift. If you enjoyed this video, give it a thumbs up, subscribe for more easy-to-digest financial guides, and drop a comment below with your questions or your own funny finance stories. Until next time, happy trading, and may your premiums be ever in your favor.